It's Friday, December 12th. I'm Brian Walsh, and welcome to This Week at Impact, where I talk with ImpactAlpha journalists and editors about some of the most interesting impact investing stories we featured. This week, I'm joined by editor David Bank. We'll discuss moving beyond simple divestment, how the endowment of one of the most influential environmental foundations is rethinking its investing approach. Plus, with support from the Nike founder, how the 1803 Fund seeks to expand community ownership of land, housing, and commercial real estate across Portland's underinvested and historically overlooked neighborhoods. And finally, practical tips for how financial advisors can talk to their clients about impact investing. That's all coming up on This Week in Impact. Hi, David. We're in the home stretch for 2025. How are you doing?
Well, we're closing out the year strong, Brian. We had a good call this week and a bunch of good stories as well.
All right. Well, first up, speaking of some good stories, one of the most influential environmental foundations is rethinking traditional approaches to impact investing. David, as you and our Rudy Sonatas wrote this week, the Sierra Club Foundation is moving beyond simple divestment of its $200 million endowment to what it calls system level investing to align its full portfolio with climate and social goals. So, David, this seems like a pretty significant evolution. What's going on here?
I learned a new phrase: engage equity, deny debt. And so the Sierra Club Foundation is the fiscal sponsor and sort of endowment of the Sierra Club, which most folks will know. It's got about $200 million in assets, and it supports the work of the Sierra Club. But as you say, they have moved away from this notion that you should just get out of all fossil fuel investments. Particularly on the equity side. So a lot of foundations and many investors hold some fossil fuel holdings in, for example, just passive index funds that might have oil companies and natural gas and other things in there. And the notion is that, it doesn't really make a big difference to get out of those holdings. What you might want to do instead is use that shareholder access to support, say, resolutions around climate change or around changing out the directors of those companies. So engagement on the equity side. On the other hand, on the debt side, on the fixed income side, you actually want to try to impose some penalties on those fossil fuel companies and raise the cost of capital, and thus make fossil fuels even less competitive than they are with renewables. Renewables are already beating fossil fuels on cost in many markets, but to make that, like, oil and gas expansion and discovery of new oils, make that process even more expensive. So the Sierra Club has, on the one hand, dumped one of their public equity advisors. It's a Perio. It's a unit of BlackRock, and in the summer they withdrew a mandate, relatively small in the scheme of BlackRock's assets, but $10.5 million, and redeployed it to some managers that have a much stronger track record of that kind of engagement. And then on the fixed income or debt side, they're going to be one of the anchor early investors in a new kind of index fund, a fixed income bond fund put out through Bloomberg and Cambridge University. And it's one of the early examples of rewarding decarbonization. So it's really about the change in the decarbonization profile of those kind of bond issues. And so, in fact, you might have a fossil fuel company in there, but one that has agreed to not do further expansion and to wind down its fossil fuel operations, maybe move into renewables. So it's not so much just on the sector, it's really on the kind of use of proceeds of the bond issues towards decarbonization. So both changes on the equity side, changes on the debt side. There's one other thing that I thought was interesting that the Sierra Club is doing, and that is they are part of what's called what's becoming a pre-declaration kind of platform. So for these kind of proxy votes and shareholder resolutions. And there's been a lot of pushback, including from the House Judiciary Committee and the administration. There was a sort of charge that there was a climate cartel and that these kind of associations of investors were somehow colluding in a kind of antitrust way on shareholder resolutions. And so what Sierra Club and some other folks are doing is just saying we're not coordinating at all. We're just going to tell you how we're voting. If you want to vote that way, that's up to you. And so this will be rolling out in the near future as a way to kind of signal without coordinating how folks like the Sierra Club Foundation are voting on shareholder resolutions.
So is this approach an acknowledgement that the divestment movement, at least on the equity side, isn't effective?
Well, there's some research that shows that these large public equities, are so liquid. There's so many different investors. You trade out your share of ExxonMobil, somebody else picks it up. It doesn't actually affect ExxonMobil very much, and so it might make you feel better, but doesn't really have much effect on the company's operations. Where you could have possibly some effect, and in fact, in ExxonMobil's case, it did have a big effect, was when folks that voted for a different slate of directors a few years back. So the notion is engage equity, and then on the debt side, try to raise the cost of capital.
And just on the equity side, though, too, the other thought there is that I would assume that the growth in passive investing in these ETF funds and large index funds that have stakes in all of these public companies, that means that most of the investors in these public equities are passive. And so they're not doing active engagement. So divesting doesn't really work on the individual stock side of things.
Well, that's a practical obstacle, absolutely. And passive just means that you're investing according to an index, and you're not picking stocks individually. It doesn't necessarily mean you have to be passive in the sense of engagement. You can be very active in engaging your passive holdings. But on that score, there's been an interesting evolution, because these big asset managers, BlackRock, State Street, Vanguard, are in many cases the biggest holders of those oil company stocks, making them candidates for this kind of active stewardship of passive holdings. But in recent years, because of pushback on both sides, really, first on the environmentalist side for not doing enough, and then more recently from essentially the fossil fuel lobby for doing too much, the big asset managers have been trying to get out of the business of voting on their shareholder resolutions. In many cases, under the guise of sort of shareholder democracy, they've kind of devolved the voting rights back to the actual holders, and that leads to the need for this kind of pre-declaration platform. But really, BlackRock and others, should have a position on climate. Larry Fink several years ago said climate was sort of an existential issue for all companies, and then more recently said, well, we're not really taking a position on that. So that was part of why not just Sierra Club Foundation, but the New York City pension funds recently recommended that they not renew BlackRock's mandate, and the PGGM, which is a big pension fund manager in the Netherlands, declined to renew quite a bit bigger mandate than the Sierra Club's 10 million, more like 17 billion. So some of the asset owners are trying to get more active, as you say, on their passive investments.
So on the debt side of things, so tell me more about the theory behind this Bloomberg Cambridge University fund, this fixed income index. So who are they trying to attract to be part of this?
Yeah, it's just coming out, so we'll dig more deeply into it, but it kind of relates to this broader concept of universal owners. And universal owners is just the notion that big investors in particular are so broadly diversified that they don't just own an individual issue in an individual company. They, in a sense, own the whole market. And in fact, a big chunk of the performance of their portfolio is related just to the performance of the market, the performance of the economy, not to some stock picking expertise that they might have. And that used to be, like I said, the biggest pension funds and sovereign wealth funds that have hundreds of billions of dollars. But in fact, anybody in their 401k who invested across a passive index fund is also kind of owning the economy. And really, the most of the gains or losses in their portfolio is going to come from the performance of the whole marketplace, the performance of the whole economy. So in that case, you want to make sure that any individual holding or individual company is not having a negative effect on the whole system. So that's what has come to be called system level investing, where you're thinking more broadly, more holistically, and you don't want, the gains of one company to bring down the whole economy. And you start looking at these kind of systemic risks, chief among them, of course, climate change, but also income inequality, biodiversity, even pandemics, other things that might bring down the whole system. This bond fund tries to take account of that and in this case, specifically by targeting decarbonization as the measure and directing funds to decarbonizing companies and then withholding fixed income kind of bond proceeds from companies that are continuing to expand in fossil fuels.
So is divestment from ownership in public companies passé at this point, and this move towards systems level investing doesn't include that kind of equity and divestment strategy?
I don't. I think passé may be overstating it. I think a lot of folks will just have a kind of emotional or visceral reaction against holding too much fossil fuel in their portfolios, including folks in the Sierra Club Foundation orbit. So it's not necessarily a finished conversation. The Sierra Club Foundation now, though, is trying to take a leadership role in kind of popularizing or at least explaining, streamlining these kind of system level investing practices. So that's a growing field, and everybody's been starting to talk about system level investing a lot more.
All right. Well, you can read Rudy and David's article about the Sierra Club Foundation's new investment approach on impactalpha.com. There's also a link in our show notes. Later on, we'll recap this week's call for how financial advisors can talk to their clients about impact investing. But for now, we'll take a quick break. When we come back, how the 1803 Fund is investing deeply in rebuilding Portland, Oregon's historically black neighborhoods, block by block and zip code by zip code.
Sign up for Impact Alpha's free weekly newsletter, Impact Alpha Open, a crisp, expert-curated investment briefing that lifts up people, data, tools, trends, and job opportunities to help you stay ahead of the curve. Find the Alpha in Impact. Visit impactalpha.com/open to learn more.
David, our Rudy Sonatas also wrote for us this week about the 1803 Fund in Portland, Oregon, which is backed by a major commitment from Nike founder Phil Knight and his wife. Now, this story captures a striking model of place-based impact investing that goes far beyond traditional funding, essentially reweaving the economic and social fabric of Black neighborhoods in Portland. So to start us off, can you walk us through what the 1803 Fund is, how it got started, and what makes its approach to rebuilding neighborhoods distinct from typical real estate investing or community development?
Yeah, there's a woman, Rukiah Adams, and I met her a couple years ago. She laid out this ambition to me, and I was super impressed. And now it's coming to fruition. And they just bought some land, spent about $70 million, and bought about a dozen acres in Portland, 3 acres in what was called Albina Riverside. It was an old grain silo site in Portland's East Bank, and then another 7 acres in the city's low end district, as it's called. And it's the first land purchases in what they think will be like $1 billion impact investment into the historically Black neighborhoods of Portland, particularly this Albina neighborhood where Rukiah grew up. And it turns out that Phil Knight, who's the founder of Nike, grew up in the kind of white working class neighborhood next door to Albina and used to run, as Nike founders tend to do, through that neighborhood, knew that neighborhood, and as he got wealthier, helped fund things like youth sports programs and scholarships. And Rukiah actually was a beneficiary of some of that. So she got to meet Phil Knight at one point and say, this is what your money has gone to. And she became quite a distinguished investor with the Meyer Memorial Trust and Oregon's public pensions. And so he tapped her when he had this idea to really put some serious money, $400 million, and do sort of a very focused place-based investment in Portland to show kind of what could be done if you really put the kinds of resources in a very focused way onto a particular place. And so they're building out kind of all the kind of things you might imagine, from affordable housing to mixed-use retail and community spaces and open spaces. And what's interesting is that one of her conditions for taking on this challenge was that the community had to be benefiting from this development, not displaced, as is the case in many of sort of inner city neighborhoods that kind of get hot and trendy in some way, and then the residents are priced out and the businesses are priced out. So in this case, they're taking that into account, obviously in the upfront planning, but also in the exit over time, and there's going to be a kind of a community real estate investment trust that the neighbors and residents can buy into. So essentially, they're talking about an exit to community over about 5 to 7 years, and there'll be a good chunk, they say, of community ownership of these assets.
So how will that work in practice? Because that's a super interesting concept here of like really trying to kind of put into practice here a community ownership plan. But the residents would have to buy into it though at some point.
Yeah, this is kind of an element of a number of things that we've been tracking, where you make an opportunity for relatively low dollar amounts and maybe savings over time, and it could be a few dollars, $10 a month or something, but that where local residents get some equity in commercial real estate. Commercial real estate actually has been quite a good and solid investment, but very hard to access for retail investors and small investors. And so the notion is, let folks invest small amounts of money in their own communities. They both then benefit from the uplift in that community. Maybe also, tend to maybe want to shop in those local stores, that knowing that they have a stake in it. And then in some cases, get a decent exit. So in fact, in Portland, also a different outfit is a community investment trust. Rudy also wrote about it several months ago. Had bought a strip mall on a different part of Portland, and local businesses, located there, and local residents shopped there, and there was local residents had become investors in it, and then they could also withdraw that money, and so there were cases where folks took the money out to start their own restaurant or to put the down payment on a house. So part of it is giving folks the ability to get into these investments that might be able to kind of stake them on their own path to ownership and wealth appreciation.
And tell me a little bit about where the name 1803 Fund comes from.
Yeah, I didn't know this bit of history. It's the year that the Lewis and Clark expedition got going, and there was a person, part of that expedition, named York, and he was enslaved and pressed into service on the expedition, but became a vital part of the expedition, and they arrived at what is now Portland in 1805, after having set out in 1803. And York has become something of a kind of local celebrity in Portland. A few years ago, after they took down some statues of folks who maybe had a more, let's say, controversial history, a kind of a pirate sculptor placed a sculpture of York in a public place, and now I think that's been replaced. I think that one got maybe vandalized as well, but now that's been replaced. So York's become kind of a local figure in the Portland context, and the 1803 Fund kind of pays homage to that whole piece of history.
And indeed, and part of this fund's mandate here is to kind of revitalize Black neighborhoods that were decimated in the 1950s and 60s with redlining and construction of highways that split up neighborhoods and the like.
Yeah, I mean, it's kind of a classic story, in many cities. There were, very thriving Black business districts when was a critical mass of Black consumers. There'd be Black-owned banks and insurance companies and newspapers and obviously restaurants and hair salons and department stores. And then through a combination, as you say, of redlining and other things, and then I-5 came through Portland in 1967. In some of the sort of tumult of that decade, there were riots there that further hollowed it out. And so these once thriving Black neighborhoods that were filled with jazz clubs and folks going out and enjoying themselves become kind of much more down and out. And the notion here is that that can be kind of brought back and restored, and that there's kind of a historically Black part of Portland that can be a kind of a center of a reborn community.
All right, well, you can read Rudy's article about the 1803 Fund and its impact on Portland, Oregon on impactalpha.com. There's also a link in our show notes. But for now, we'll take one more quick break. When we come back, highlights from this week's call about tackling roadblocks faced by financial advisors when engaging their clients on impact investing. Finally, this week, David, Impact Alpha hosted its latest call, this time all about how financial advisors can navigate conversations with their clients, particularly as we approach what's being called the Great Wealth Transfer, when trillions of dollars will be passed down from one generation to the next. So, what were some of the highlights of the call, and how are financial advisors handling these kind of conversations with their clients?
Yeah, advisors are kind of the key glue or connectors between clients with assets and then impact investments that need investment, and they've been both an enabler and in some cases an obstacle. And so what we've been trying to do in partnership with CapShift is kind of surface practical advice for advisors. So how can advisors start to get comfortable both recommending and managing and shepherding their clients into impact investing? It's an interesting dynamic with all kinds of issues around expertise and authority and power. And CapShift's Liz Sessler said that the first thing is just talk about it, just get started, ask the question. Here's what she had to say.
There's a bit of a chicken and an egg problem. We hear from a number of advisors that, oh, nobody ever asks about impact, or this isn't something that we have demand for. We also hear clients who have fired their advisor because they didn't offer them impact, but they never had the conversation. And so I would just flag this as an area in particular where I think there's nervousness, both at the client level, right? The client hires an advisor to be the expert, and they don't want to be seen as foolish for asking about impact investing, for asking about values alignment. And the advisor likes to be an expert. And so they stay focused on what they know and understand. I think this is a real opportunity for people to grow together.
So then, David, how does that relate to this great wealth transfer?
Well, people have been talking about this for quite a while, and basically it's the transfer from the greatest generation, the silent generation, and even the boomers to younger generations. And one of the things that I think scares the hell out of the advisors is that quite a number of the heirs, the inheritors, change their advisor when they come into this money. They either just want to do things their way, or in many cases they actually want to make their money do more than just support their returns, but also to have some effect on the things they care about, on their values. And so the point of the call really is, can you engage your clients about their values and then help them align their whole portfolios to reflect those values. And that will be a boon to your advisory business.
So what are the other takeaways for advisors as they navigate this landscape?
Well, we tried to point the call very practically to how do you move your advisory business more towards impact investing. So there's a number of courses and training materials for advisors. There's all kinds of platforms, including CapShift, that can help you get access to products, to investment opportunities that you can offer your clients. There's things like we highlighted investyourvalues.org, where folks can put up the mutual funds or the ETFs they hold and see how they rate on things like fossil fuel free indexes or gender lens indexes, or even things like firearms or deforestation. So there's many more sources of data, sources of tools, sources of products that advisors can use to help their clients start on this journey. And I think Liz again's point was just get started. That helps not only start moving money, but also just starts the conversations with clients, and that's a value in itself for the advisors.
All right. Well, you can read a write-up about this week's call and view a full replay on ImpactAlpha.com. But for now, that's going to do it for this episode of This Week in Impact. Thank you, David.
Thanks, Brian. It's a pleasure.
And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, Managing Director of the impact advisory firm Human Nature. We'll see you next week for more Impact.